Monday, February 26, 2024, Maneco 64, home of alternative economics and contrarian views. We're going to look at pensions today, and in particular, defined benefit pensions here in the UK. You might remember back in 22, after the gilt markets collapsed, the pound went almost 1-to-1 with the dollar. That sector of the pension system, had to be bailed out by the Bank of England. But believe it or not, with all our economic woes, of course, the Chancellor, the government, they're looking to go after your defined benefit pensions. Not really go after and take it, but they're looking to put it in even more danger, in my opinion, and that's what we're going to look at. And it's not surprising because we've got so much debt as a nation, and as I said, the economy is in a recession, and they have to find ways to fund their schemes, and they're going to come after not just your pensions, a lot of other things. And we're going to look at that today because there's some important news about defined benefit pensions that I think you should know. Before I do, though, I'd like to talk a little bit about diversification, because with what's going on, I think diversifying is important, not within the system, but outside the system. And that's something that I did back in 2002. After I experienced the first really major crisis in my adult working life, and I saw my pension pot drop quite a bit, my wife and I decided to diversify outside the system with gold. And the first people we contacted, because I had to do a bit of research, I didn't know who dealt in gold, but after a bit of research, I went to Gold Investments, and I still go to Gold Investments when I need to add on to my reserves. And I've become affiliated with them for the last 5 or 6 years here through the channel, because many of you have asked where they can get gold. So just wanted to remind you that if you have any questions, if you haven't bought gold or silver, and if you're thinking about it, make sure, if you want to learn more, to call Gold Investments and speak to Oliver Temple or Simon Temple. They're brothers. I started dealing with their father, Mike Temple, over 20 years ago. And for those of you, of course, who already deal with Gold Investments, there's some interesting specials in the description of this video. So let's get back to the pension situation. Well, it's not surprising in times of banking troubles, debt troubles for the government, that they come after your money. They did that in 1933 in the United States when FDR confiscated the public's gold. They shut the banks and they took people's money because they're desperate. And I think they're desperate again. And one thing that is shocking to me is that less than 2 years ago, these defined benefit pension programs, and they're private pensions, of course. For those of you who don't know about defined benefit, it just means that your company pays into a pension. The money is managed by the pension fund managers. And at the end of your career, when you're retired, they give you a defined amount every month. That's how it works. That's why it's called a defined benefit pension. But back in 2022, and they'll keep blaming Liz Truss, of course, and her budget for this, but it triggered it. But the whole problem with the UK and other countries, for that matter, is the huge amount of debt that we've accumulated because we've abused a bull market in bonds where interest rates were always falling. But now things have turned, and interest rates probably not in my lifetime will ever go back to like near zero. If anything, they're going to go up. even into double digits, I would say. So it creates a lot of problems, especially in 2022 when we saw interest rates rise very quickly. And they're still at levels where we were in 2022 when the crisis started. And what it did, it triggered something we didn't even know, a derivative called LDI, leverage. I think I forgot the exact name. We're going to go through it in a minute. Yeah, it triggered a derivative that they were using to increase returns because rates are so low, right? So they couldn't really, the funding was really difficult to fund the current retirees. So they use leverage, and the rise in interest rates and the fall in the value of gilts, which are used in these defined benefit pensions, basically meant that the system wasn't on the brink of collapse. And I'll show you here, the Bank of England had to come in and save the day. How do they save the day? Well, they just print money out of thin air, right? Money that's worthless that they just type on a keyboard and they save the system, right? Well, they just kick the can down the road. So here you go. LDI crisis is spurring a seismic shift in the gilt market. EU urged to help pension funds on margin calls. So you can see how investigation needed to hold those behind UK pension crisis to account. The upside of a gilt market crisis. So it was a huge thing here, as you can see, in 2022. UK pension funds call on Bank of England to extend bond purchases. So there you go. They had to come in and bail everyone out. Again, well, the LDI. So what is LDI? Let's have a quick look. Yeah, liability-driven investing. And it's another kind of derivative that we didn't know about. So yeah, the derivatives market is a can of worms. And the reason we have derivatives is because everything is so, how can I say, leveraged. And they do it through the derivatives because they're greedy, or a lot of times, rates were too low for too long and they needed the return. So they leveraged everything. And then when rates rise very quickly, it blows everything up. Um, and now, though, this is what I wanted to talk to you about. Now that rates have stabilized at these higher levels that triggered the crisis, uh, ministers set out plans to ease access to UK pension scheme surpluses. So now, from being almost bankrupt, these pension schemes, they've got a surplus because the Bank of England, they've stabilized the market with QE back in 2022. Interest rates have stabilized, but as I said earlier, I think the bull market in bonds, or interest rates and yields always going lower, like we saw since the 80s up until 2021. I think that's over. But what that has done, the stabilization here in the last 12 months or a year and a half or so, it's made these guys look at this. It says proposals come after recent period of rising interest rates left majority of defined benefit plans in the black. And you might think, well, rising interest rates are good for the plans. Well, it depends how quickly they rise. Right now, of course, they've plateaued. And so they're getting a better return, and they've gone from being bankrupt to having a surplus. And it's weird because now in this article here from February 23rd, they don't even talk about the crisis in 2022. So let's quickly go through it. It says employers access to billions of pounds of surpluses in UK company pension funds would be eased under the proposal set out by the government on Friday. The proposals come after the funding positions of defined benefit retirement plans have improved significantly over the past 18 months due to rising interest rates, making it cheaper for the schemes to meet the cost of their pensions obligations. Yeah, they didn't make it easy back in 2022 because they were out of control interest rates, right? And I think they could get out of control again. So I think this is crazy what they're doing. They should leave your defined benefit pensions alone. But as I said, they're in trouble. They need your money. A recent analysis by the pensions regulator estimated that more than 3,750 of UK's 5,000 private sector DB schemes were in the black, with an aggregate surplus of more than 225 billion. The government said it was considering a statutory override. Well, that means breaking the rules, isn't it? An override to allow the trustees of the schemes, also known as final salary pensions, to share the surpluses to the appropriate funding levels. The current rules, which differ from plan to plan, make it difficult or in some cases impossible to tap excess cash and are designed to protect members' benefits, which need to be funded during their lifetimes. Yeah, and they need the surplus because we have another interest rate or gilt crisis. They're going to need it. And if they take your surplus now, it's going to put your defined benefit pensions in trouble again. And this is the excuse here. We are in a welcome position. Yeah, well, now you are, with DB pension schemes enjoying high levels of funding, and we want to make this money work harder. No, they don't want to make it work harder. They're looking after their own interests, not yours. Work harder for savers and the wider economy, said Paul Maynard, Minister for Pensions. There's potential for trustees to share surplus with scheme members and sponsoring employers in recognition of their historical contributions. Current legislation, however, makes it difficult and costly for many scheme trustees to do this. So, yeah, as I said, I think this is a bad idea. Uh, I mean, we had a crisis less than 2 years ago, and now they're saying, "Oh, everything's fine. We're going to come after your pensions," and they will come after your pensions. I mean, they're coming after your surplus and investing that money in things that could be very dangerous. And it's money that you've saved all your life and you put in there. I think they should stop messing about with this. So it's dangerous, people. And Jeremy Hunt is also looking to interfere again in the housing market. He's looking to create this scheme that helps people put only 1% down to buy a home. So they are desperate. They want to keep the housing bubble going. They need to fund the government. I bet you they would put a lot of this surplus cash from the defined benefits pension in schemes that would help the government and their cronies as well. So beware, people. I'm not sure what you can do about it. Maybe you can contact the people who run these pensions in your company and say that you're against this. But at the end of the day, they'll do whatever they want because they're in charge. And it's not going to help the economy if they go after the surplus. Problem is the massive inflation we've had for 30 years, inflation of the money supply. You know, they've hidden the what the inflation really is, and they tell you that CPI is inflation that's really low. That's the whole problem. And until we look at that, all of this stuff is gimmick, but it's dangerous gimmick that could put your savings into into jeopardy, I would say. So it's 8:32 a.m. London time. So let's quickly look at where the markets are this morning. So today I'm doing the video a bit differently so I can share the data with you. You can see that gold is unchanged. That's been the range there, 2039 to 2029. Silver is a little weaker, still struggling to get back above that 23 level. You can see the Dow futures down a little bit, so is the Nasdaq, S&P. Everything's really quiet here, though, as you can see. Let's quickly look at the other currencies like the Aussie dollar. That's down a little bit, 0.2, 65.50. The dollar versus the Canadian dollar is unchanged, as you can see. And if we scroll back down here, the Kiwi dollar is down about 0.5%, 61.66. And now we can look at commodities. WTI crude is trading at 76, down 0.5%. And Brent just above, well, trading at 80.40. So oil has come off a little bit. Platinum is down a little bit, but stuck around that 900 level. And there's copper down 0.75%. And now let's look at the bond markets. Well, here's my investing.com page for treasuries. Well, the 10-year yield is down overnight. It's at 4.22. So right now, they've been able to keep it below that 4.33 level, which helps everything, I guess. And here in the UK, if we look at these rates, yeah, they're steady. As I said, they're steady and they're high. And that's why those pensions, then defined benefit pensions, are doing well. What you need to look here is if it starts moving rapidly. And by rapidly, I mean, if we go, let's say today from 426, and then tomorrow we're at 450, then they're red flags. And I think they would definitely have to consider these plans to tap into these surpluses. So there you go, 426. The 5 year is around 4%. So yeah, always be careful, I would say, especially if you've got things like defined benefit pensions and even your savings in the bank or through national savings or ISAs. And I'm not saying they're going to come and take your money, but the currency is debasing a lot quicker than they're rewarding you with in terms of interest. So you're losing purchasing power. And they're going to try to do that as much as possible because the government is the biggest debtor out there. So they have to devalue the currency without you knowing it, and they gain and you lose. And that's why I've been and will continue to stack gold, because gold has, well, since the year 2000, returned over 10% in sterling terms. And it's done really well for the last 60 years. If you watch my live stream from yesterday, I spoke about the fact that gold has come from £12.50 an ounce in 1962 now to 1,600. And yeah, short term it will fluctuate, but over the next 30 years, it will still be there and the purchasing power will still be strong, in my opinion. So with that, I'm going to wish you all a very good day. Take care. Bye.